$15 trillion dollars circulating outside America's borders, completely unregulated, beyond the Federal Reserve's control, invisible to most economists. This isn't cryptocurrency. This isn't some emerging market phenomenon. This is US dollars, your dollars, operating in a parallel financial universe that most people don't even know exists. The Eurodollar market is larger than the entire US money supply. It's bigger than China's banking system. It dwarfs every stock market except America's. And yet, if you asked 100 people on the street what Eurodollars are, maybe one could tell you. Here's what's terrifying. This massive, unregulated pool of dollars has been at the center of every major financial crisis for the past 50 years. The Latin American debt crisis of the 1980s, Eurodollars. The Asian financial crisis of 1997, Eurodollars. The 2008 global financial meltdown, Eurodollars were ground zero. When Lehman Brothers collapsed in September 2008, it wasn't just an American bank failing. It was the moment the Eurodollar system, the hidden plumbing of global finance, seized up completely. Credit froze worldwide, not because the Federal Reserve stopped lending, but because banks in London, Paris, Tokyo, and Hong Kong suddenly didn't trust each other with dollars that existed outside any government's jurisdiction. But what nobody understands is how this system was created, not by central banks or governments, not by international treaty or careful planning. The Eurodollar market was born from a Cold War accident, exploited by clever bankers, and allowed to grow into a financial monster that now controls global trade, emerging market debt, and the stability of the entire world economy. The Federal Reserve, the most powerful central bank in history, doesn't control it, can't regulate it, doesn't even fully understand it. When financial crises hit, the Fed scrambles to pump dollars into this shadow system through emergency swap lines and backdoor mechanisms that most Americans never hear about. This is the story of how US dollars escaped America, how a handful of Soviet bureaucrats and British bankers accidentally created the world's largest unregulated financial market, how this invisible system became more important to global finance than the Federal Reserve itself, and how the next financial crisis will almost certainly start in the Eurodollar market, just like the last one did. This is the untold story of the financial system that runs the world. Today, the Eurodollar system is the backbone of international finance, but it started as a quirk, a historical accident born from Cold War paranoia and regulatory arbitrage. The outcome is staggering. Between $15 and $20 trillion in US dollar-denominated deposits and loans exist outside the United States and outside American regulatory control. This is money that looks like dollars, functions like dollars, and denominates contracts like dollars, but exists in a regulatory no-man's land beyond any government's direct authority. Most people hear Eurodollar and assume it's some European currency or maybe related to the euro. Wrong on both counts. Eurodollars are simply US dollars held in banks outside the United States, initially in Europe, hence the name, but now literally anywhere. A dollar deposited in a bank in London, Hong Kong, Singapore, or the Cayman Islands becomes a Eurodollar. Same currency, different regulatory universe. What most people don't know is that this system didn't emerge from careful planning or international cooperation. It emerged from Soviet fear of American asset seizures, British banks exploiting regulatory loopholes, and American banks discovering they could avoid Federal Reserve regulations by booking transactions offshore. The origins trace back to 1957. The Cold War was intensifying. The Soviet Union earned dollars from selling gold, grain, and oil to Western countries. But Soviet officials faced a dilemma: where to keep those dollars? American banks were the obvious choice. They were safe, liquid, and offered good returns. But what if the US government froze or seized Soviet assets during a political crisis? This wasn't paranoid fantasy. The US had frozen Chinese assets after the Communist Revolution in 1949. The Soviets watched and learned. They needed to hold dollars, the world's dominant currency for international trade, but they couldn't risk keeping them in American banks, where the US government could seize them. The solution was elegant. Deposit dollars in European banks, particularly in London and Paris. These dollars remained denominated in US currency, but they sat in banks outside American jurisdiction. The Soviets could use them for international transactions without fear of confiscation. British and French banks were happy to accept these deposits. They could use dollar deposits to make dollar-denominated loans, earning the interest rate spread without needing to comply with American banking regulations. The Eurodollar market was born, initially tiny, just a few $100 million, but with explosive potential. Behind the Eurodollar market's growth was a powerful economic incentive: regulatory arbitrage. Banks operating in the United States faced Federal Reserve regulations. They had to maintain reserve requirements, keeping a percentage of deposits in non-interest-bearing accounts at the Fed. They had to comply with interest rate caps on deposits. They faced capital requirements, reporting obligations, and examinations by bank regulators. But a bank in London accepting dollar deposits? None of those rules applied. No reserve requirements meant banks could lend out a higher percentage of deposits. No interest rate caps meant they could offer depositors better returns. Less regulatory overhead meant lower costs. The Eurodollar market offered better rates to depositors and borrowers while generating higher profits for banks. American banks noticed. By the 1960s, major US banks were opening London offices specifically to participate in Eurodollar banking. They could book dollar transactions through their London branches and avoid Federal Reserve regulations while still ultimately controlling the business. It was the perfect regulatory workaround. The market exploded. From a few $100 million in 1957, the Eurodollar market grew to $9 billion by 1964, $57 billion by 1970, and over $500 billion by 1980. Today, it's estimated between 15 and 20 trillion, though the exact number is unknown because much of the market operates outside formal reporting requirements. Here's the thing: the Eurodollar market isn't just about deposits. It's about the entire offshore dollar banking system. Eurodollar loans finance international trade. Emerging market governments borrow in Eurodollar markets. Corporations issue Eurodollar bonds. Banks lend Eurodollars to each other in the London interbank offered rate, LIBOR market, which until recently set the interest rates for trillions in global contracts. This matters because the Eurodollar system creates dollars beyond the Federal Reserve's direct control. When a bank in London makes a dollar loan, it creates new dollar-denominated credit without needing dollars from the Federal Reserve. This is shadow banking on a global scale, money creation happening outside the regulated banking system. The Federal Reserve can control the domestic US money supply. It can't directly control Eurodollars. When financial crises hit, this creates terrifying scenarios where global demand for dollars explodes, but the supply mechanism exists outside the Fed's regulatory reach. The 2008 financial crisis revealed this vulnerability catastrophically. European banks had created trillions in dollar-denominated liabilities. They owed dollars to creditors, but didn't have access to dollar funding when credit markets froze. The Federal Reserve had to establish emergency swap lines with foreign central banks, essentially providing dollars to the entire world to prevent global financial collapse. What's interesting is that the Eurodollar system persists precisely because it serves powerful interests. Banks profit from regulatory arbitrage. International corporations need dollar financing for global trade. Emerging markets depend on Eurodollar lending for development. And the United States benefits from the dollar's global dominance, even if that dominance operates partly outside American control. But the system is inherently fragile. It's built on trust. Trust that banks will honor dollar-denominated obligations. Trust that counterparties are solvent. Trust that liquidity will be available in crisis. When that trust breaks, as it did in 2008, the entire global financial system seizes up. Let me take you back to where it all began, to a Cold War standoff that accidentally created the infrastructure of modern global finance, to the moment when the dollar escaped America's borders and began a life of its own in the shadows of international banking. This is how the Eurodollar market was born. Chapter 1. Cold War birth, 1957 Moscow. Soviet financial officials faced an urgent problem that would accidentally reshape global finance. The Soviet Union earned substantial hard currency from selling commodities to the West: gold from Siberian mines, grain from Ukrainian farms, oil from the Caucasus. Western countries paid in dollars. the dominant international currency since the Bretton Woods Agreement of 1944, had established the dollar's convertibility to gold and its role as the world's reserve currency. The Soviets needed these dollars. They used them to purchase machinery, technology, and goods from Western countries that wouldn't accept rubles. But where should they keep this growing pile of dollars? The obvious answer was American banks. US banks were stable, offered reasonable interest rates, and could facilitate international transactions easily. Several Soviet trade agencies had maintained dollar accounts in New York banks throughout the 1950s for exactly these reasons. But then came the Suez Crisis of 1956. When Britain and France invaded Egypt with Israeli support, the United States opposed the invasion politically. President Eisenhower threatened economic consequences if the Allies didn't withdraw. The message was clear. The US would use financial pressure to enforce its foreign policy. Soviet officials watched this closely. If America would pressure its own allies financially, what would it do to the Soviet Union during a crisis? The precedent was already established. The US had frozen Chinese assets in 1949 after Mao's Communist Revolution. Over 80 million in Chinese government and private funds held in American banks became inaccessible overnight. You see, the Soviets understood that holding dollars in American banks created vulnerability. Those assets sat within US legal jurisdiction. If relations deteriorated, a very real possibility during the Cold War, the US government could freeze or seize Soviet funds with a simple executive order. The Soviet state bank, Gosbank, began exploring alternatives. They needed to hold dollars for international trade, but they needed those dollars outside American jurisdiction. The solution emerged from an unlikely source, a small British bank called Midland Bank and its merchant banking subsidiary. In February 1957, the Soviet state bank transferred a substantial portion of its dollar holdings from New York to London. The Soviets opened dollar-denominated accounts at British banks, primarily Midland Bank and Moscow Narodny Bank, a Soviet-owned bank operating in London since the 1920s. These weren't pound sterling, these were US dollars, the same currency, the same denomination, just held in banks outside the United States. The Soviets could still use these dollars for international transactions, but the funds sat beyond the reach of American authorities. British banks were delighted to accept these deposits. Sterling was weak in the 1950s. Britain's post-war economy was struggling, and the pound's international role was declining. By accepting dollar deposits, British banks could participate in international finance using the world's dominant currency without needing to strengthen sterling. The term Eurodollar emerged almost immediately. Some sources credit Moscow Narodny Bank's cable address, Eurobank, as the origin. Others suggest it simply described dollars in Europe. Regardless, the name stuck, and the market began to grow. Initially, the market was tiny, a few $100 million at most. Soviet accounts dominated, but the mechanism, dollar deposits in non-US banks, had been established, and other players quickly noticed the opportunity. What made this significant was the regulatory arbitrage potential. US banks operating domestically faced Federal Reserve Regulation Q, which capped the interest rates banks could pay on deposits. They faced reserve requirements, forcing them to keep a percentage of deposits as non-interest-bearing reserves at the Fed. They faced capital requirements, examinations, and reporting obligations. British banks accepting dollar deposits faced none of these restrictions. They could pay higher interest rates to attract deposits because they didn't have to maintain reserves at the Fed. They could offer better loan rates to borrowers because their cost of funds was lower and they had less regulatory overhead. The spread between deposit rates and lending rates could be narrower while still generating attractive profits. Here's what's interesting. The British government welcomed this development. London had been the world's financial center before World War II, but that position had eroded as America emerged as the dominant economic power. The Eurodollar market offered London a path back to international financial prominence. British regulators deliberately maintained a light-touch regulatory approach. They didn't impose reserve requirements on dollar deposits. They didn't cap interest rates. They allowed banks to operate with minimal oversight as long as the business was conducted in foreign currencies, primarily dollars, rather than sterling. This created a perfect environment for market growth. Soviet deposits proved the concept. British banks gained experience. And then, American banks discovered they could use their London offices to escape Federal Reserve regulations. By the early 1960s, major US banks, Citibank, Chase Manhattan, Bank of America, were opening London branches specifically to participate in Eurodollar banking. They could accept dollar deposits from international clients, make dollar loans to borrowers worldwide, and book the transactions through London to avoid Fed regulations. The Federal Reserve watched this development with growing concern. The Fed's primary tools for controlling the money supply, reserve requirements, interest rate regulations, open market operations, assumed that dollar banking happened within US borders under Fed jurisdiction. But Eurodollars were creating a parallel dollar banking system beyond the Fed's control. Think about it. When a bank in London accepts a dollar deposit and makes a dollar loan, it's creating new dollar-denominated credit. This looks like money creation, functions like money creation, and affects global dollar liquidity, but happens outside the Federal Reserve's regulatory framework. The Fed couldn't simply ban the practice. The dollar deposits were held abroad in foreign banks under foreign jurisdiction. American banks' London offices were technically foreign entities. The Fed had no legal authority to regulate foreign banks' dollar operations. Some Fed officials argued for aggressive action, restricting American banks' ability to transfer dollars to offshore branches, imposing reserve requirements on offshore dollar lending, or pressuring foreign governments to regulate Eurodollar operations. But these proposals faced serious obstacles. First, restricting capital outflows would contradict America's free market principles and international commitments. Second, foreign governments had no incentive to help the Fed regulate Eurodollars. The market benefited their banks and financial centers. Third, aggressive action might push the market further offshore to less friendly jurisdictions. The Fed chose a path of watchful concern, but limited action. They monitored Eurodollar growth. They studied the market's implications, but they didn't shut it down. This decision, or non-decision, had enormous consequences. The Eurodollar market continued growing exponentially. By 1964, Eurodollar deposits exceeded $9 billion. The genie was out of the bottle. What started as Soviet paranoia about asset seizures had become a sophisticated market serving multiple purposes. Oil exporters in the Middle East used Eurodollar accounts. European corporations borrowed Eurodollars for expansion. International trade was increasingly financed through Eurodollar loans. The market had achieved critical mass, but the fundamental characteristics established in 1957 remained. Eurodollars existed outside regulatory oversight. They responded to market forces rather than central bank control. They created dollar liquidity beyond the Federal Reserve's direct influence. And they operated based on trust and convention rather than legal frameworks and government backing. The Cold War had accidentally created the infrastructure for what would become the world's largest shadow banking system. Soviet officials wanted financial security. British bankers wanted to restore London's prominence. American banks wanted to avoid regulations. None of them fully understood they were building something that would eventually dwarf the regulated banking system and become central to global finance. The Eurodollar market was no longer just about Soviet deposits. It was becoming the operating system for international dollar finance, and it was only beginning. Chapter 2: London's Loophole. The 1960s transformed the Eurodollar market from a Cold War curiosity into a genuine financial innovation that would reshape global banking. London became the undisputed center of this new market, and that wasn't an accident. The City of London, Britain's financial district, had centuries of experience in international banking. British merchant banks had financed global trade since the 1700s. London had been the world's financial capital before World War II devastated Britain's economy and transferred financial dominance to New York. The Eurodollar market offered London a path to reclaim international financial leadership, and British authorities seized the opportunity with deliberate policy choices that created the perfect regulatory environment for offshore dollar banking. The Bank of England, Britain's central bank, adopted what would later be called light touch regulation for Eurodollar operations. The policy was simple: As long as banks conducted their dollar business with non-British clients and didn't threaten the domestic British banking system, regulators would impose minimal oversight. This wasn't negligence, this was strategy. British officials understood that strict regulation would push the Eurodollar market to other locations, Zurich, Luxembourg, or emerging financial centers in Asia. London's competitive advantage was regulatory arbitrage, and the Bank of England protected that advantage carefully. The contrast with American banking regulation was stark and deliberate. In the United States, banks faced Federal Reserve Regulation Q, which capped interest rates on deposits. The ceiling was 5.5% on time deposits, regardless of market conditions or inflation rates. This created obvious problems during periods of rising interest rates, when market rates exceeded regulatory caps. Eurodollar deposits faced no such restrictions. If market conditions justified 7% or 8% interest rates, London banks could pay them. This made Eurodollar deposits attractive to anyone with dollars to invest, particularly corporations and wealthy individuals seeking market rate returns. Reserve requirements created another massive advantage. US banks had to maintain reserves at the Federal Reserve, typically 10 to 20% of deposits held in non-interest-bearing accounts. This was dead money from the bank's perspective, reducing their ability to lend and earn returns. Eurodollar banking had zero reserve requirements. A London bank accepting $1 million in deposits could theoretically lend the entire amount, maximizing leverage and profitability. In practice, banks maintained some liquidity buffer, but the lack of mandatory reserves meant dramatically higher lending capacity. You see, these regulatory differences created a self-reinforcing cycle. Lower costs meant Eurodollar banks could offer better deposit rates and better loan rates simultaneously. Better rates attracted more deposits and more borrowers. More business meant more profit. More profit attracted more banks to London. More banks meant deeper markets and better liquidity. Better liquidity attracted even more business. American banks couldn't ignore this. By 1963, virtually every major US bank had established a London presence. They opened branches, acquired British banks, or formed joint ventures with British partners. The strategy was transparent: book dollar business through London to avoid Fed regulations, while maintaining ultimate control from US headquarters. Citibank led the charge. Under CEO Walter Wriston, Citibank aggressively expanded its international operations throughout the 1960s. The bank's London office became a major Eurodollar dealer, accepting deposits from international clients and making dollar loans worldwide. By the late 1960s, Citibank's international operations were more profitable than its domestic business. Other banks followed. Chase Manhattan, Bank of America, Morgan Guaranty, all established significant London operations. The competitive dynamic was clear. Any bank that didn't participate in Eurodollar banking would lose market share to banks that did. But here's what made the situation particularly interesting. The Eurodollar market wasn't just about avoiding regulations. It was about creating a genuinely global dollar banking system that could operate 24/7 across time zones. In the traditional banking system, dollar transactions required access to the US banking system, which operated on New York business hours. If a Japanese company wanted to borrow dollars at 3 a.m. Tokyo time, they'd have to wait for New York banks to open. The Eurodollar market solved this problem. Banks in London could lend dollars during European business hours. Banks in Hong Kong and Singapore could handle Asian hours. By the late 1960s, dollar banking was effectively a 24-hour global market, with transactions handed off between London, New York, and Asian financial centers as the sun moved around the world. This global accessibility made the dollar even more dominant in international trade. Companies could access dollar financing anytime, from anywhere. This convenience reinforced the dollar's position as the world's reserve currency and transaction medium. The Vietnam War accelerated Eurodollar market growth in an unexpected way. As US military spending abroad increased, dollars flooded into foreign hands. European companies that sold goods to US military forces received dollar payments. Foreign governments hosting American bases received dollars. This created a massive supply of offshore dollars seeking investment opportunities. Simultaneously, the US government became concerned about capital outflows. As dollars left America, To finance the war and international expansion, the US balance of payments deteriorated. In 1963, President Kennedy imposed the interest equalization tax, which penalized Americans who invested in foreign securities. In 1965, President Johnson introduced voluntary restraints on foreign lending by US banks. In 1968, these restraints became mandatory. These policies were intended to keep dollars in America. They had the opposite effect. By restricting US banks' ability to lend dollars domestically for international purposes, the regulations pushed more business into the Eurodollar market, where the restrictions didn't apply. Think about it. A foreign company needing a dollar loan couldn't easily borrow from a US bank due to the outflow restrictions, but they could borrow Eurodollars from that same bank's London office. The policy designed to control dollar flows actually accelerated the Eurodollar market's growth. By 1970, the Eurodollar market exceeded $57 billion, more than 10% of the US money supply, and growing faster than domestic banking. The market had achieved critical mass and was becoming systemic to global finance. British banks benefited enormously. Midland Bank, Barclays, National Westminster, institutions that had been declining in international importance, became major players in global dollar finance. London's financial employment grew. The City of London regained prominence as an international financial centre, albeit as an offshore hub for American currency rather than a centre of sterling finance. The term offshore banking entered the financial lexicon. While Eurodollars technically existed in physical locations, London primarily, they were offshore in the sense that they operated outside the regulatory framework of their home currency jurisdiction. This concept would later expand to Caribbean tax havens and Asian financial centres, but London pioneered the model. Interestingly, the Eurodollar market also created the first significant international interbank market. Banks with excess dollar funds would lend to banks needing dollar liquidity. Interest rates for these interbank loans, initially called the London Interbank Offered Rate, or LIBOR, became the benchmark for international dollar lending. LIBOR would eventually become one of the most important numbers in global finance, serving as the reference rate for over $300 trillion in contracts by the 2000s. Its origins were in the informal Eurodollar interbank market of the 1960s, where banks in London lent each other dollars and established market-driven interest rates free from central bank control. What's fascinating is that nobody designed this system. There was no Eurodollar charter, no founding treaty, no international agreement. The market emerged organically from the interaction of regulatory arbitrage, technological change, telecommunications made global banking feasible, and the dollar's dominance in international trade. The Federal Reserve watched with increasing unease. By 1969, Fed economists were publishing research papers analyzing Eurodollars and their implications for monetary policy. The concerns were serious. If Eurodollars could expand and contract outside Fed control, how could the Fed manage the money supply? If banks could avoid regulations by booking transactions offshore, how could the Fed ensure financial stability? Some Fed officials proposed creating reserve requirements for Eurodollars or restricting American banks' offshore operations. But these proposals faced political opposition from banks and were complicated by international legal issues. The dollar was America's currency, but Eurodollar deposits were held abroad under foreign law. The Fed's authority was unclear. The situation created a strange paradox. The Eurodollar market's growth enhanced the dollar's global dominance. More people wanted to hold and use dollars. But that dominance increasingly operated outside American control. The Fed could influence dollar interest rates through domestic policy, but Eurodollar rates responded to supply and demand in offshore markets. This tension between the dollar as America's currency and as the world's currency would define monetary policy challenges for the next 50 years. The Eurodollar market had made the dollar global, but making something global meant losing exclusive control over it. By the end of the 1960s, the Eurodollar market was no longer an experiment or a loophole. It was infrastructure, the essential plumbing for international dollar finance. Companies depended on Eurodollar loans. Banks depended on Eurodollar interbank lending. Central banks held Eurodollar deposits as reserves. The system had become too important to shut down, even if regulators wanted to. London's loophole had become the foundation of a shadow financial system that would grow to rival and eventually exceed the regulated banking system in size and importance. The Eurodollar empire was rising. Chapter 3: Shadow Banking. The 1970s revealed what the Eurodollar market really was, the world's first shadow banking system operating at global scale. Shadow banking, the term wouldn't be coined until much later, refers to financial intermediation that happens outside the regulated banking system. It looks like banking, functions like banking, and creates systemic risks like banking, but operates beyond the regulatory framework designed to ensure stability. The Eurodollar market embodied this perfectly. Banks accepted deposits, made loans, created credit, and managed liquidity, all traditional banking functions. But they did it with dollars outside the United States, beyond Federal Reserve oversight, without deposit insurance, and without the safety nets that protected domestic banking. What made this system particularly powerful and dangerous was its ability to create money. Here's how traditional money creation works. When a US bank makes a loan, it creates a deposit in the borrower's account. This new deposit is new money. It didn't exist before the loan. The bank is creating money through the act of lending, constrained by reserve requirements and capital regulations that limit how much money banks can create relative to their capital base. Eurodollar banking worked similarly, but without the constraints. When a London bank made a dollar loan, it created a dollar-denominated deposit. This was new dollar credit created outside the Federal Reserve's control. No reserve requirements limited this creation. No single regulator oversaw total Eurodollar expansion. The market grew based on demand and banks' willingness to lend. The multiplier effect was dramatic. A dollar deposited in a Eurodollar bank could be lent to another party, who would deposit it in another bank, which would lend it again. Each iteration created new dollar-denominated credit. The original dollar could support many times its value in total Eurodollar claims. Economists debated whether Eurodollars were real money or just credit instruments. The debate missed the point. Eurodollars functioned as money for international purposes. They were used to denominate contracts, settle trades, and store value. Whether they technically counted as M1 or M2 money supply was irrelevant to their economic impact. By 1973, the Eurodollar market exceeded $160 billion. For context, total US M1 money supply, currency plus checking deposits, was around $262 billion. The offshore dollar market was approaching the size of the domestic money supply with none of the regulatory oversight. The 1973 oil crisis accelerated Eurodollar growth dramatically. When OPEC quadrupled oil prices, it created an enormous wealth transfer from oil-importing countries to oil exporters. Arab oil states suddenly had hundreds of billions of dollars in revenue that needed to be invested. These petrodollars flooded into Eurodollar markets. Oil exporters deposited dollars in London, Paris, and New York banks. The banks needed to lend these dollars to earn returns on the deposits. The result was an enormous surge in Eurodollar lending to emerging markets. You see, emerging market governments desperately needed capital for development. Infrastructure, industry, education. Domestic savings were insufficient. Traditional sources like World Bank loans were limited and came with conditions. But Eurodollar banks were eager to lend, flush with petrodollar deposits and seeking borrowers. Latin American countries, Mexico, Brazil, Argentina, borrowed heavily. African nations borrowed. Asian economies borrowed. The loans were denominated in dollars, carried floating interest rates usually tied to LIBOR, and totaled hundreds of billions by the late 1970s. The lending was often reckless. Banks competed to lend, offering favorable terms and overlooking borrowers' limited repayment capacity. A famous quote from Citibank CEO Walter Wriston captured the attitude. Countries don't go bankrupt. The assumption was that sovereign borrowers, unlike private companies, couldn't fail because they had taxing authority and would always repay. This assumption would prove catastrophically wrong. But before examining the crisis this created, it's important to understand how the Eurodollar market was operating by the mid-1970s as a fully functional shadow banking system with several key characteristics. First, maturity transformation. Like traditional banks, Eurodollar banks engaged in maturity transformation, borrowing short-term, accepting deposits that could be withdrawn, and lending long-term, making loans that wouldn't be repaid for years. This created liquidity risk. If depositors suddenly withdrew funds, banks might not have liquid assets to return. In domestic banking, deposit insurance and central bank lender of last resort facilities managed this risk. The FDIC insured deposits, preventing runs. The Federal Reserve could lend to banks facing liquidity problems. These safety nets stabilized the system. Eurodollar banking had no such safety nets. No deposit insurance existed for Eurodollar accounts. No lender of last resort stood ready to provide emergency liquidity. The system operated on confidence, trust that banks were solvent and that liquidity would be available when needed. This made the Eurodollar market inherently fragile. A loss of confidence could trigger a run, with depositors withdrawing funds and refusing to roll over maturing deposits. Banks would be forced to call in loans or sell assets at distressed prices. The resulting liquidity crisis could cascade through the entire market. Second, regulatory arbitrage as core business model. The Eurodollar market's fundamental competitive advantage was avoiding regulations. This wasn't incidental, it was the entire point. Banks operated offshore specifically to escape reserve requirements, interest rate caps, and capital regulations. This created a race to the bottom. Financial centers competed to offer the lightest regulatory touch. London led, but Luxembourg, Switzerland, Singapore, Hong Kong, and Caribbean islands all developed Eurodollar banking capabilities with minimal oversight. The result was a global network of offshore financial centers, each offering slightly different advantages, but all sharing the core feature of regulatory arbitrage. Money flowed to wherever regulations were lightest and taxes lowest. Third, complexity and opacity. The Eurodollar market was deliberately opaque. No comprehensive data collection existed. Banks didn't report Eurodollar positions to any central authority. Regulators couldn't see the full picture of who owed what to whom in dollar terms. The Bank for International Settlements, BIS, an organization of central banks based in Basel, Switzerland, began collecting some Eurodollar data in the 1960s. But reporting was voluntary and incomplete. The BIS could estimate market size but couldn't track specific exposures or counterparty relationships. This opacity created information asymmetry. Banks couldn't fully assess their counterparty's solvency. Regulators couldn't identify systemic risks. The market operated with significant blind spots that would only become visible during crises. Fourth, dollar dominance without dollar control. Perhaps most importantly, the Eurodollar system demonstrated that the dollar had become truly global, used and needed worldwide, but no longer exclusively controlled by American authorities. The Federal Reserve could influence Eurodollar markets indirectly through US interest rates and monetary policy. But the Fed couldn't directly control Eurodollar expansion, couldn't set reserve requirements for Eurodollar lending, and couldn't act as lender of last resort for Eurodollar banks, at least not without controversial emergency measures. This created a fundamental disconnect. The dollar's global role had outgrown the Fed's authority. The currency was used for trillions in international transactions, but the institution responsible for that currency's stability had limited tools to manage its offshore incarnation. Think about the implications. When crisis hit, who would stabilize the Eurodollar market? When liquidity dried up, who would provide emergency dollars? When banks failed, who would step in? The answers were unclear, dangerously unclear. By 1979, the Eurodollar market exceeded $500 billion. It was larger than most countries' economies. It financed a substantial portion of international trade and emerging market development, and it operated with virtually no official oversight or safety net. Federal Reserve Chairman Paul Volcker, who took office in 1979, understood the risks. Volcker had been president of the New York Federal Reserve and had watched the Eurodollar market grow throughout the 1970s. He knew it represented a massive pool of dollar-denominated obligations beyond the Fed's control. In 1979, Volcker began aggressively raising interest rates to combat double-digit inflation. The federal funds rate, the Fed's benchmark, rose from 11% to over 20% by 1981. This created profound stress in the Eurodollar market. Higher US interest rates meant higher Eurodollar rates. Borrowers who'd taken floating-rate Eurodollar loans suddenly faced crushing interest costs. A loan at 8% in 1978 might be costing 18% by 1981. For developing countries already struggling with oil price shocks and recession, this was catastrophic. The stage was set for the first major Eurodollar crisis, and it would reveal just how dangerous this shadow banking system had become. Chapter 4. Global Expansion. The late 1970s and early 1980s represented the Eurodollar market's peak arrogance, a period when banks believed they'd perfected international lending and that the party would never end. The numbers were staggering. Mexico's external debt grew from $20 billion in 1975 to $80 billion by 1982. Brazil's debt exploded from $30 billion to $90 billion. Argentina, Venezuela, Chile, Peru all borrowed heavily. Across Latin America, total external debt exceeded $300 billion by 1982. Most of it, Eurodollar loans at floating interest rates. The banks loved this business. Lending to sovereign governments seemed safe. Countries had taxing authority and natural resources. The interest rate spreads were attractive, typically 1 to 2 percentage points above LIBOR. And the volumes were massive, generating huge fee income from loan originations, syndications, and restructurings. But nobody was asking the critical questions. How would these countries repay? What happened if commodity prices fell? What if global interest rates rose? What if multiple countries faced problems simultaneously? The assumption underlying all this lending was that problems would be isolated and manageable. If one country struggled, it could be bailed out without threatening the broader system. This assumption was spectacularly wrong. What made the situation particularly dangerous was the concentration of lending. A handful of major American banks, Citibank, Chase Manhattan, Bank of America, manufacturers Hanover, had enormous exposures to Latin American debt. By 1982, the 9 largest US banks had Latin American loan exposures exceeding 180% of their total capital. If those loans defaulted, the banks would be insolvent. Look, the banks knew they were concentrated, but they believed the diversification across multiple countries provided safety. Mexico's problems wouldn't necessarily affect Brazil. Argentina's issues wouldn't spread to Chile. This geographic diversification supposedly managed risk. What they missed was that all these countries faced similar vulnerabilities. They all depended on commodity exports, oil, copper, agricultural products. They all had borrowed in dollars while earning revenue in local currencies. They all had floating rate debt exposed to interest rate shocks. They were all vulnerable to the same macroeconomic forces. The Eurodollar market had created a massive common exposure disguised as diversification. Asian economies were also tapping Eurodollar markets, though generally more cautiously than Latin America. South Korea, Indonesia, Thailand, and the Philippines borrowed for development. The amounts were smaller than Latin American totals, but the pattern was similar. Dollar-denominated debt, floating rates, dependence on export revenues. European corporations were sophisticated Eurodollar users. Rather than borrowing from banks, many large companies issued Eurobonds, dollar-denominated bonds sold to international investors through London and Luxembourg. The Eurobond market, closely related to Eurodollar banking, exceeded $100 billion by 1980. Middle Eastern oil exporters remained major Eurodollar depositors. After the 1979 oil price spike, triggered by the Iranian Revolution, petrodollar deposits surged again. Banks were drowning in deposits and desperately needed lending opportunities to earn returns on these funds. This created perverse incentives. Banks weren't carefully evaluating loan quality. They were pushing loans to deploy excess deposits. Loan officers were incentivized on volume, not risk management. Country risk analysis was rudimentary at best. Citibank was particularly aggressive. Under Walter Wriston's leadership, Citi viewed international lending as the future of banking. The bank had operations in over 90 countries. Its international division was larger and more profitable than its US retail business. Citi was the world's bank, and Riston wanted to dominate global finance. But Riston's confidence in sovereign lending was based on faulty logic. His famous quote, "Countries don't go bankrupt," confused legal bankruptcy with practical default. True, countries couldn't file for bankruptcy court protection like corporations, but they absolutely could stop paying their debts. History was full of sovereign defaults. The difference was that sovereign defaults tended to be negotiated restructurings rather than formal bankruptcies. Countries would negotiate with creditor banks to extend maturities, reduce interest rates, or even forgive portions of debt. These restructurings were messy, took years, and often resulted in losses for creditors. But the banks had convinced themselves this time was different. Modern financial markets and international institutions would prevent defaults. The International Monetary Fund would step in with bridge financing. Countries had learned from past mistakes and were managing their economies better. The post-war international order made default unthinkable. Every one of these assumptions would be tested and found wanting. The interest rate shock came first. When Paul Volcker raised US rates to 20% in 1981, Eurodollar rates followed. LIBOR, the benchmark for most Eurodollar loans, spiked to 18 to 19%. Countries that had borrowed expecting 10% rates suddenly faced debt service costs nearly double what they'd projected. For Mexico, this was catastrophic. The country had borrowed approximately $80 billion, much of it at floating rates. When interest rates doubled, Mexico's annual debt service jumped from manageable to impossible. The country was paying $15 billion annually just in interest, roughly 40% of export revenues. Simultaneously, global recession hit. The US entered its worst recession since the Great Depression in 1981-82. Unemployment rose above 10%, GDP contracted, and critically, commodity prices collapsed as demand plummeted. Oil prices fell from $40 per barrel to $30. Copper prices crashed. Agricultural commodity prices tanked. The commodity exporting developing countries saw their revenue streams collapse just as their debt service costs exploded. Mexico was particularly vulnerable. The country had been borrowing to finance government spending, assuming high oil prices would continue generating revenue. When oil prices fell and interest rates rose simultaneously, the mathematics became impossible. The crisis broke on August 12, 1982. Mexican Finance Minister Jesus Silva Herzog traveled to Washington to deliver shocking news. Mexico couldn't pay. The country needed immediate emergency financing, or it would default on over $80 billion in external debt. This was the nightmare scenario banks had dismissed as impossible. A major sovereign borrower, one of the largest economies in Latin America, was declaring it couldn't meet its obligations. And Mexico wasn't alone. Brazil, Argentina, and other countries were in similar positions. The potential losses for US banks were staggering. Citibank had $2.8 billion in Mexican loans against $3.5 billion in total capital. Chase Manhattan had $1.6 billion in Mexican exposure. If Mexico defaulted and other Latin American countries followed, the 9 largest US banks would be insolvent. This wasn't just a banking problem, it was a systemic crisis threatening the global financial system. The Eurodollar market, which had seemed like a perpetual profit machine, had created exposures that could destroy the world's largest banks. The Federal Reserve, Treasury Department, and IMF scrambled to contain the crisis. They couldn't let Mexico default. The consequences would cascade through the banking system. But rescuing Mexico required controversial measures that pushed the boundaries of the Fed's authority. What's interesting is that this crisis revealed the Eurodollar market's fundamental vulnerability. The system had created enormous dollar-denominated obligations, but no lender of last resort existed to provide emergency dollar liquidity when things went wrong. The Fed was designed to stabilize US domestic banking. It could lend to US banks facing liquidity problems, but Eurodollar lending happened through banks' offshore branches or through foreign banks. The Fed's legal authority to support these operations was questionable. Nevertheless, the Fed acted. It provided dollar swap lines to foreign central banks. It encouraged US banks to roll over Latin American loans rather than demanding payment. It worked with the IMF to assemble bailout packages. The goal was to prevent immediate defaults while forcing borrowing countries to implement economic reforms. Mexico received an emergency package of $4.5 billion, some from the IMF, some from the US government, some from the Bank for International Settlements. In exchange, Mexico agreed to harsh austerity measures, currency devaluation, and economic restructuring. But Mexico wasn't the only problem. Within weeks, Brazil needed emergency support, then Argentina, then Venezuela. The Latin American debt crisis had become systemic, affecting most of the region simultaneously. The banks were forced to acknowledge reality. Starting in late 1982, they began setting aside reserves for potential loan losses. They stopped booking optimistic profit projections. They admitted their Latin American portfolios were troubled. Stock prices of major banks collapsed. Citibank's stock fell 50% in 1982-83. Chase Manhattan, Bank of America, and others suffered similar declines. Investors understood these banks were essentially insolvent if their Latin American loans were marked to realistic values. The crisis would drag on for years, the lost decade for Latin America. Countries were locked in cycles of recession, inflation, and debt renegotiation. Banks were locked in complex restructuring negotiations. Economic growth stalled across the region. Chapter 5: Crisis Amplifier. The 1990s proved that the Eurodollar market wasn't just a shadow banking system. It was a crisis amplification machine capable of turning regional problems into global catastrophes. By 1990, the Eurodollar market exceeded $4 trillion, larger than the GDP of every country, except the United States and Japan. But size alone didn't capture the market's systemic importance. The Eurodollar system had become the primary mechanism for international capital flows, the infrastructure for global dollar liquidity, and the transmission belt for financial contagion. The Mexican peso crisis of 1994 provided the first demonstration of how Eurodollar dynamics could destabilize even a seemingly healthy economy. Mexico had spent the early 1990s as a reform success story. The country had opened its economy, privatized state industries, joined NAFTA, and attracted enormous foreign investment. Capital flooded in, much of it dollar-denominated. Foreigners held Mexican government bonds, called tesobonos, denominated in dollars. Mexican companies borrowed in Eurodollar markets. Banks had dollar-denominated liabilities. This created a dangerous mismatch. Mexican borrowers owed dollars, but they earned revenues in pesos. As long as the peso remained stable against the dollar, this worked. But if the peso weakened, the real burden of dollar debts would explode. In December 1994, the Mexican government devalued the peso after depleting its foreign exchange reserves, defending an unsustainable exchange rate. The peso collapsed from 3.4 to over 7 per dollar in a matter of weeks, a decline of more than 50%. Mexican borrowers suddenly faced catastrophic problems. A dollar debt that required 3.4 million pesos to service now required 7 million pesos, double the burden. Companies couldn't pay. Banks faced massive loan defaults. The country needed dollars to meet its obligations, but nobody wanted to lend dollars to Mexico. This was a classic Euro-dollar crisis. The problem wasn't just Mexican economic mismanagement. It was the interaction between dollar-denominated obligations and local currency revenue streams, a structural vulnerability created by Eurodollar financing. The crisis threatened to spread beyond Mexico. Investors worried that other emerging markets faced similar vulnerabilities. They started pulling capital from Brazil, Argentina, and other Latin American countries. Stock markets crashed across the region. The tequila effect, contagion from Mexico's crisis, threatened to trigger a broader emerging market collapse. The US government and IMF assembled a $50 billion rescue package, the largest international bailout in history at that time. The goal was to provide Mexico with dollar liquidity to meet its obligations and prevent default. But the package was controversial, requiring President Clinton to use emergency authorities because Congress refused to approve it. Think about what this represented. A crisis in Mexico, a country with 2% of global GDP, required a $50 billion international bailout to prevent contagion through the Eurodollar system. The shadow banking system had created linkages that made regional problems globally systemic. But Mexico was just a preview. The real disaster came in 1997 with the Asian financial crisis, a catastrophe that revealed how Eurodollar dynamics could destroy even rapidly growing, seemingly well-managed economies. The Asian tigers, Thailand, South Korea, Indonesia, Malaysia, had been growth miracles throughout the 1980s and early 1990s. They'd industrialized rapidly, maintained high savings rates, and integrated into global markets. International investors poured capital in, financing the Asian boom. Much of this capital came through the Eurodollar system. Asian banks borrowed dollars in international markets. Asian companies issued Eurobonds. Foreign banks extended dollar credit lines. By 1997, total external debt in Asian emerging markets exceeded $700 billion, most denominated in dollars. The same dangerous dynamic that destroyed Mexico was operating in Asia. Borrowers owed dollars, but earned revenue in local currencies: Thai baht, Indonesian rupiah, Korean won. As long as exchange rates remained stable, the system worked. But these countries had adopted de facto currency pegs to the dollar, and those pegs were becoming unsustainable. Thailand broke first. In July 1997, after months of defending an overvalued baht and depleting foreign exchange reserves, the Thai government abandoned its currency peg. The baht collapsed, losing 50% of its value in months. Thai borrowers suddenly faced impossible debt burdens. Banks that had borrowed dollars abroad to fund domestic lending couldn't service their Eurodollar obligations. Companies that had issued dollar bonds faced bankruptcy. The country needed massive dollar inflows to prevent financial collapse, but capital was fleeing. What happened next demonstrated the Eurodollar system's contagion power. Investors looked at other Asian countries and saw similar vulnerabilities: fixed exchange rates, large dollar-denominated debts, banking systems with currency mismatches. They started pulling capital from Indonesia, South Korea, Malaysia, and the Philippines. This created self-fulfilling prophecies. Capital flight put pressure on currencies. Currency weakness increased dollar debt burdens. Rising dollar debts forced asset sales and austerity. Economic contraction made debts even more unpayable. More capital fled. Currencies collapsed further. The death spiral accelerated. Indonesia was particularly catastrophic. The rupiah fell from 2,400 per dollar to 16,000 per dollar, an 85% collapse. Indonesian borrowers saw their dollar debts increase sevenfold in local currency terms. Banks failed. Companies went bankrupt. The economy contracted 13% in 1998. Riots and political instability followed. South Korea faced potential sovereign default. The country was the world's 11th largest economy, a major exporter, and seemingly well managed. But Korean banks and chaebols, large conglomerates, had borrowed heavily in Eurodollar markets. When creditors refused to roll over short-term dollar loans, Korea faced a liquidity crisis. You see, this was the Eurodollar system's inherent fragility on full display. The borrowing was short-term, frequently 90-day or 180-day loans that needed to be continuously rolled over. As long as creditors kept renewing the loans, the system functioned. But when confidence broke and creditors refused to roll over maturing debt, borrowers faced immediate payment demands they couldn't meet. Korea needed $60 billion in emergency IMF support, the largest rescue package in IMF history. The bailout came with brutal conditions: high interest rates to defend the currency, massive corporate restructuring, banking sector reforms, and labor market reforms. The medicine worked but was economically devastating. Korea's economy contracted 6% in 1998, unemployment tripled, and poverty soared. The crisis revealed something terrifying about the Eurodollar system. It could create sudden stops in capital flows that were economically catastrophic, regardless of underlying economic health. Korea wasn't a basket case like Indonesia. Its fundamentals were relatively sound. But the Eurodollar system's dynamics, short-term dollar debt, currency mismatches, and confidence-driven liquidity, could destroy even strong economies. The Asian financial crisis cost the region an estimated $2 trillion in lost GDP. Currencies collapsed, stock markets crashed, millions lost jobs, political instability erupted across multiple countries, and the mechanism was the same in each case. Dollar-denominated debts became unpayable when currencies weakened, creating vicious cycles of currency collapse, debt distress, and capital flight. For the Eurodollar market, the crisis demonstrated its role as a crisis amplifier. The initial problems, overvalued exchange rates, excessive short-term borrowing, were serious but potentially manageable. The Eurodollar system's dynamics transformed them into catastrophes. The IMF and international financial community proposed reforms. There was talk of regulating cross-border capital flows, limiting currency mismatches, and creating international bankruptcy procedures for countries. But most proposals were watered down or abandoned. The Eurodollar system was too entrenched, too profitable, and too politically protected to change fundamentally. What did change was rhetoric. Economists and policymakers started warning about currency mismatches, original sin, the inability of emerging markets to borrow in their own currencies, and sudden stops in capital flows. These concepts described Eurodollar dynamics, even if they didn't always name the market explicitly. Some countries learned defensive lessons. Asian economies built up massive foreign exchange reserves, dollar reserves that could be used to defend currencies or repay dollar debts during crisis. By the 2000s, China held over $3 trillion in reserves, largely in US treasuries. Other Asian countries held hundreds of billions. This reserve accumulation was insurance against euro-dollar-driven crises. But reserve accumulation had its own problems. It meant emerging markets were lending to the US at low interest rates to protect themselves from dollar debt crises. The global financial system was becoming increasingly bizarre, poor countries lending to rich countries to insure against currency and debt crises caused by rich countries' currency dominance. The Eurodollar market by 2000 exceeded $8 trillion. Far from being chastened by the Asian crisis, the market had continued growing. Financial innovation was creating new dollar-denominated instruments, currency swaps, credit derivatives, asset-backed securities. Many traded through offshore markets with Eurodollar-like characteristics of minimal regulation and opacity. Chapter 6. Federal Blindness. The Federal Reserve in the 2000s was extraordinarily sophisticated in some ways and remarkably blind in others. The blindness concerned the Eurodollar system, the offshore dollar banking network that had grown to rival the domestic financial system, but remained largely invisible to US regulators. Fed officials understood Eurodollars existed. They tracked the market size through BIS data. They knew about currency mismatches in emerging markets, but they fundamentally misunderstood the systemic risk building in the shadow banking system and how interconnected it was with US financial institutions. The problem was conceptual. The Fed's regulatory framework assumed that controlling the US banking system meant controlling dollar finance. If the Fed regulated banks, set capital requirements, examined balance sheets, and managed the money supply through reserve requirements and interest rates, the financial system would be stable. This assumption was decades out of date. By 2005, enormous amounts of dollar banking were happening offshore, outside the Fed's regulatory reach. European banks had massive dollar operations. Investment banks created complex dollar-denominated securities. Shadow banking institutions provided dollar credit without being banks in the regulatory sense. The Fed was regulating a shrinking portion of a much larger system. European banks were particularly important. Deutsche Bank, UBS, Barclays, BNP Paribas, and others had built massive dollar operations. These weren't small operations. By 2007, European banks held over $10 trillion in dollar-denominated assets. That was roughly equal to the total assets of all US commercial banks combined. How did European banks get so large in dollars? Through the Eurodollar market mechanisms established decades earlier. They accepted dollar deposits from international clients. They borrowed dollars in wholesale funding markets. They issued dollar-denominated bonds. They engaged in currency swaps to create synthetic dollar funding. These banks used dollars to make dollar loans globally. They financed trade. They provided corporate credit. They invested in US mortgage-backed securities and other dollar assets. They were essentially operating as global dollar banks, providing dollar services worldwide. But here's the critical point. These banks weren't part of the US banking system. They weren't regulated by the Fed. They didn't have access to the Fed's discount window for emergency borrowing. They weren't covered by FDIC insurance. If they faced a dollar liquidity crisis, the Fed had no obligation and questionable authority to help them. The Fed understood European banks were active in dollar markets, but Fed officials believed these banks' home central banks would provide support if needed. If Deutsche Bank faced problems, the European Central Bank would handle it. If UBS needed emergency liquidity, the Swiss National Bank would help. This analysis missed something crucial. European central banks didn't have dollars. They couldn't print dollars. If a European bank needed emergency dollar liquidity, the European Central Bank couldn't manufacture dollars to lend. Only the Federal Reserve could create dollars. Think about the vulnerability this created. European banks had trillions in dollar assets, funded by trillions in dollar liabilities. If their dollar funding dried up, if depositors withdrew funds or wholesale lenders refused to renew short-term loans, these banks would need emergency dollars. But no lender of last resort existed for their dollar operations. The Fed assumed this wouldn't matter because European banks were sophisticated, well regulated by their home authorities, and wouldn't allow dangerous dollar mismatches. These assumptions were completely wrong. Meanwhile, the shadow banking system in the United States was creating its own Eurodollar-like dynamics. Investment banks, money market funds, repo markets, and asset-backed commercial paper programs were all providing dollar credit outside the traditional banking system. These institutions looked different from Eurodollar banks, but functionally they were similar. They engaged in maturity transformation, borrowed short to lend long, operated with limited regulation, and lacked access to Fed safety nets. When crisis came, they'd face the same problems as Eurodollar banks. They'd need dollars, but no lender of last resort existed for them. The housing bubble of 2003-2007 created the conditions for disaster. As home prices soared, mortgage lending exploded. But critically, much of this lending wasn't done by traditional banks. It was done by mortgage brokers who immediately sold the loans to investment banks, which packaged them into securities sold to investors worldwide, including European banks hungry for dollar-denominated yield. This created complex chains. A borrower got a mortgage from a broker. The broker sold it to an investment bank. The investment bank packaged it with thousands of other mortgages into a mortgage-backed security, MBS. The MBS was sold to a European bank. The European bank funded the purchase by borrowing dollars short-term in Eurodollar markets. Every link in this chain created risk. The borrower might default. The broker had no incentive to ensure quality since they immediately sold the loan. The investment bank cared about fees, not long-term performance. Rating agencies were paid to rate securities day to day. And the European bank was creating maturity and liquidity mismatches, borrowing short-term to buy long-term illiquid assets. The Fed was aware that housing prices were rising rapidly and mortgage credit standards were deteriorating. Fed officials debated whether they should take action to cool the market. But they decided against aggressive intervention, reasoning that housing was a regional market and that banks appeared well capitalized to handle potential losses. This analysis was correct for traditional bank exposure, but missed the bigger picture. The real risk wasn't in banks' balance sheets, it was in the shadow banking system. Investment banks held mortgage exposure, but weren't regulated like banks. European banks held enormous mortgage securities funded through Eurodollar markets. Special purpose vehicles and structured investment vehicles held mortgages funded by short-term commercial paper. The entire housing finance chain was built on shadow banking, and shadow banking was built on Eurodollar-style dynamics of unregulated leverage, maturity mismatches, and absent safety nets. Fed Chair Alan Greenspan famously dismissed concerns about derivatives and complex securities, arguing that market discipline and sophisticated risk management would prevent problems. His successor, Ben Bernanke, initially described subprime mortgage problems as contained to that specific market segment and unlikely to threaten the broader economy. These assessments revealed a fundamental misunderstanding of how the financial system actually operated. The Fed was still thinking in terms of banks, deposits, loans, and traditional credit intermediation. But finance had evolved into a complex global system where dollar credit was created through securities, derivatives, and wholesale funding markets, much of it happening offshore or in shadow banking institutions beyond the Fed's visibility. You see, the Fed's regulatory radar couldn't see the full system. They examined US banks, and those banks looked reasonably safe. They saw European banks' US operations, but assumed home regulators managed overall risks. They knew shadow banking existed, but underestimated its size and interconnection with the regulated system. When crisis came in 2007-2008, the Fed would be repeatedly surprised by problems emerging from unexpected places. French bank BNP Paribas freezing withdrawals from funds invested in US subprime mortgages? Unexpected. British bank Northern Rock facing a bank run? Didn't see it coming. Bear Stearns needing emergency support? Surprising. Lehman Brothers collapse triggering global crisis? Shocking. Each surprise revealed the same underlying problem. The Fed didn't understand the Eurodollar system's central role in global finance. They didn't grasp how dependent European banks were on dollar funding. They didn't appreciate how interconnected shadow banking was with the regulated system. They didn't recognize that the offshore dollar world they'd ignored for decades had become systemically critical. The Federal Reserve's blindness to the Eurodollar system wasn't stupidity. The Fed employed brilliant economists and experienced financial professionals, but their analytical framework was outdated, their regulatory authority was limited, and their mandate focused on domestic US banking. More fundamentally, acknowledging the Eurodollar system's importance would have required acknowledging uncomfortable truths. The Fed didn't actually control dollar finance globally. Huge portions of dollar banking happened beyond their authority. When crisis came, they'd need to support foreign banks and shadow institutions to stabilize the system, actions that would be politically controversial and legally questionable. It was easier to believe the system was stable, that market discipline would prevent excess, that sophisticated institutions could manage their own risks. The Fed convinced itself that it understood the financial system, when in reality, it was monitoring one part of a much larger, increasingly fragile structure. By 2007, the Eurodollar system and its shadow banking cousins in the US had created the largest, most leveraged, most interconnected financial structure in human history. It exceeded $50 trillion in total, several times the size of the visible regulated banking system. It was built on confidence, short-term funding, and assumptions that markets would always provide liquidity. Chapter 7, 2008. Meltdown. The global financial crisis of 2008 was many things: a housing bubble bursting, a derivatives disaster, a regulatory failure. But at its core, it was a Eurodollar crisis, a massive seizure of the offshore dollar funding system that threatened to destroy the global financial system. Understanding this requires understanding what actually broke in September 2008. The crisis began in 2007 when subprime mortgage defaults started rising, and the value of mortgage-backed securities began falling. But this alone didn't cause global catastrophe. Losses on subprime mortgages, even massive losses, were absorbable by the financial system. The crisis escalated because of what those losses did to the Eurodollar funding system. European banks, as mentioned earlier, held trillions in dollar-denominated assets, including massive quantities of US mortgage-backed securities. These banks had funded their dollar assets by borrowing dollars short-term in wholesale markets, particularly through asset-backed commercial paper, repurchase agreements, repo, and interbank lending. This created ticking time bombs. When mortgage securities fell in value, European banks suffered losses. More importantly, investors and lenders became uncertain about which banks held toxic assets and how large the losses would be. This uncertainty triggered a classic shadow banking dynamic. Lenders refused to roll over short-term funding to banks they didn't trust. By August 2007, this dynamic was visible. BNP Paribas, France's largest bank, announced it was freezing withdrawals from 3 investment funds, because it couldn't value the US mortgage securities they held. This was a stunning admission, a major bank declaring it didn't know what its assets were worth and couldn't allow investors to withdraw their money. The freeze triggered panic in money markets. If BNP Paribas didn't know what its assets were worth, how could anyone know what any bank's assets were worth? Lenders began hoarding cash and refusing to lend to banks they viewed as risky. The Eurodollar interbank market, where banks lent dollars to each other, started malfunctioning. The LIBOR-OIS spread, a key measure of bank funding stress, widened dramatically. Normally, this spread was 10-15 basis points, reflecting low risk in short-term bank lending. In August 2007, it jumped to 80 basis points. Banks were charging much higher rates to lend to each other, reflecting fear and uncertainty. The European Central Bank and Federal Reserve both injected liquidity into the banking system. The ECB provided euros, the Fed provided dollars. But the injections weren't enough to restore confidence. The problem wasn't just liquidity, it was trust. Banks didn't trust each other's solvency, so they wouldn't lend regardless of liquidity availability. Throughout 2007 and early 2008, the crisis simmered. Banks faced recurring funding pressures. Asset values continued falling. Central banks provided repeated liquidity injections, but the system hadn't broken completely, yet. Then came September 2008, the month everything collapsed. On September 7, the US government seized Fannie Mae and Freddie Mac, the giant mortgage finance companies. On September 14th, Bank of America announced it would purchase Merrill Lynch, which was on the verge of failure. On September 15th, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy after the government refused to rescue it. Lehman's eye. Bankruptcy was the earthquake. Lehman had $600 billion in assets and was deeply interconnected with the global financial system. It was a major participant in Eurodollar markets, repo markets, derivatives markets. Its bankruptcy meant thousands of counterparties suddenly faced losses on their Lehman contracts and exposures. But the real impact was psychological. If Lehman could fail, if the government would allow a systemic institution to collapse, then any institution could fail. All assumptions about implicit government backing for large financial institutions were shattered. The Eurodollar system seized up completely. Banks stopped lending to each other entirely. The LIBOR-OIS spread exploded to 365 basis points. Banks were charging 3.65 percentage points above normal rates to lend to each other overnight. This wasn't just expensive. At these levels, interbank lending essentially stopped. Money market. Funds which millions of Americans used as safe cash equivalents faced runs. The Reserve Primary Fund, a major money market fund, broke the buck, fell below $1 per share, because it held Lehman Brothers commercial paper that was now worthless. Investors panicked and withdrew $300 billion from money market funds in days. Asset-backed commercial paper markets froze. Companies and financial institutions that depended on regularly issuing short-term commercial paper to fund operations couldn't sell new paper. Maturing paper wasn't being rolled over. Borrowers faced immediate funding crises. Repo markets, the multi-trillion-dollar market where institutions borrow short-term using securities as collateral, became dysfunctional. Lenders stopped accepting all but the safest collateral. They demanded huge haircuts, lending only a small percentage of collateral value. Institutions that depended on repo funding faced catastrophic liquidity problems. Think about what this meant. The entire shadow banking system, all the mechanisms for creating dollar credit outside traditional banks, stopped functioning. This was the equivalent of all banks closing their doors simultaneously. Credit simply vanished. For European banks, this was existential. They held trillions in dollar assets funded by dollar borrowing. When dollar funding markets froze, they couldn't borrow dollars to fund their operations or roll over maturing debt. They needed dollars desperately, but dollars weren't available at any price. The Federal Reserve faced a terrible choice. European banks were failing because of dollar shortages, but they weren't American banks. Did the Fed have authority to lend to foreign banks? Should the Fed bail out European institutions? If European banks failed, would it crash the US financial system? The answer to the last question was clearly yes. European banks were so interconnected with US institutions and markets that their failure would trigger cascading collapses. The global financial system was one system. The Eurodollar system had ensured that. If it collapsed anywhere, it collapsed everywhere. Ben Bernanke and the Federal Reserve made a momentous decision. They would provide dollars to the world, not just to US banks, but to foreign central banks, which could then lend dollars to their own banking systems. On September 18, 2008, 3 days after Lehman's bankruptcy, the Fed announced it would establish unlimited dollar swap lines with major central banks. The European Central Bank, the Bank of England, the Bank of Japan and others would be able to borrow unlimited dollars from the Fed, which they would then lend to their domestic banks desperate for dollar funding. This was unprecedented. The Federal Reserve was becoming the lender of last resort, not just for US banks, but for the entire global dollar system. The Fed was explicitly acknowledging that the Eurodollar system, this offshore shadow banking network they'd ignored for decades, was now their responsibility to stabilize. The swap lines were massive. At their peak in December 2008, foreign central banks had borrowed over $580 billion from the Federal Reserve. European banks alone absorbed over $400 billion in emergency dollar liquidity. The ECB was providing dollars to European banks that had never been regulated by American authorities, using dollars created by the Federal Reserve. Look, this was the Eurodollar system's endgame playing out in real time. A crisis in offshore dollar banking required the Fed to support institutions worldwide because the alternative was global financial collapse. The dollar had gone global decades earlier. Now the consequences were clear. When the global dollar system was in trouble, only the Fed could fix it, but the swap lines alone weren't enough to stabilize markets. The Fed also created an alphabet soup of emergency lending facilities. The term auction facility lent directly to banks. The commercial paper funding facility purchased commercial paper when private markets froze. The term asset-backed securities loan facility supported securitization markets. The primary dealer credit facility lent to investment banks. Each program pushed the boundaries of the Fed's authority. The Fed was lending to institutions it didn't regulate, accepting collateral it had never accepted before, and intervening in markets far beyond traditional central banking. But the alternative was watching the financial system disintegrate. The crisis peaked in late September and early October 2008. Stock markets crashed globally. The S&P 500 fell 17% in a week. Credit markets were frozen. Businesses couldn't get working capital loans. Governments around the world announced bank bailouts, deposit insurance expansions, and economic stimulus programs. Gradually, the emergency measures took effect. Dollar funding became available, though expensive and stigmatized. Banks began lending to each other again cautiously. Asset prices stabilized, then began recovering. By early 2009, the acute panic had passed, though the economic damage would persist for years. The total cost of stabilizing the Eurodollar system was staggering. The US government committed over $7 trillion to various bailouts, guarantees, and lending programs. Other governments committed trillions more. Central banks' balance sheets exploded as they purchased assets and provided liquidity. The economic damage, lost GDP, unemployment, foreclosures, exceeded $10 trillion globally. This was the price of a Eurodollar crisis, not a crisis in a small emerging market that could be isolated, a crisis in the core of the system that threatened everything. What's fascinating is how little public understanding there was of the Eurodollar system's role. Media coverage focused on Wall Street greed, subprime mortgages, derivatives, and regulatory failure. All valid. But the mechanism that transformed mortgage losses into global catastrophe, the Eurodollar funding system, remained largely invisible. Politicians debated bailouts for banks, but didn't discuss why foreign banks needed American support. Economists analyzed the crisis, but often missed the offshore dollar dynamics. The public was angry about rescuing banks, but didn't understand the system. Being rescued was global, not just American. Ben Bernanke understood. In speeches after the crisis, he explained that the Fed had to support dollar funding globally because the dollar was the world's reserve currency and the US financial system was inextricably linked to global dollar markets. But this explanation raised uncomfortable questions. If the Fed was responsible for global dollar stability, did it have adequate tools? Should foreign banks be regulated by the Fed? Who pays when the Fed rescues foreign institutions? These questions remain unresolved today. The crisis should have been the moment the Eurodollar system was finally brought under control. International coordination should have established clear oversight. Regulations should have prevented the maturity mismatches and leverage that made the system fragile. Safety nets should have been created with clear rules about who gets supported and who doesn't. Instead, the response was partial. Banks were required to hold more capital and liquidity. Some derivatives were moved to clearinghouses. Stress tests were established, but the fundamental structure, offshore dollar banking operating with limited oversight, remained intact. The swap lines became permanent. What started as an emergency measure became a standing facility. The Fed and other major central banks now have permanent agreements to provide each other with currency during crises. This was a tacit admission that the Eurodollar system was now part of the Fed's responsibility. But permanent swap lines created moral hazard. If foreign banks knew the Fed would provide emergency dollars during crisis, why maintain expensive dollar liquidity buffers during normal times? The safety net encouraged the very behaviors that made it necessary. The crisis revealed another uncomfortable truth. The Eurodollar system had made the dollar even more dominant. During the panic, every institution worldwide desperately wanted dollars. Not euros, not yen, not gold, dollars. The dollar's status as the global reserve currency and safe haven was reinforced by the very crisis that almost destroyed the dollar system. This created a paradox. The crisis proved the Eurodollar system was dangerously fragile, but it also proved the dollar was indispensable. So rather than replacing the system with something safer, the world doubled down on dollar dependence, while making only modest reforms to address the fragility. By 2010, as the acute crisis faded, the Eurodollar system was recovering. European banks rebuilt their dollar operations, though more cautiously. Shadow banking gradually resumed. Credit markets normalized. The machine was running again. The system that had nearly destroyed the global economy was back in business, ready for the next crisis. Chapter 8. Modern Empire Today. The Eurodollar system is larger and more entrenched than ever. Despite the 2008 crisis revealing its dangers, the offshore dollar banking network has continued growing and evolving. Current estimates place the Eurodollar market between $15 and $20 trillion, though the exact number remains uncertain because much operates outside formal reporting. This is larger than the GDP of every country, except the United States and China. It dwarfs most countries' entire banking systems, and it operates with far less regulatory oversight than any domestic banking system of comparable size. The modern Eurodollar system has several key characteristics that make it even more complex and systemically important than before 2008. First, it's become increasingly Asian. While London remains the largest center for offshore dollar banking, Hong Kong, Singapore, and Tokyo have grown dramatically. Asian banks, particularly Chinese, Japanese, and Korean institutions, are now major Eurodollar players. They fund dollar operations to support Asian trade, which is predominantly dollar-denominated, and to meet dollar demand from Asian corporations and governments. China's role is particularly important. Chinese banks have built massive dollar operations to facilitate China's global trade. The Bank of China, Industrial and Commercial Bank of China, and others have billions in dollar assets and liabilities. This creates another vulnerability. If US-China relations deteriorate, Chinese banks' access to dollar funding could be threatened, potentially triggering a crisis. Second, it's more interconnected with emerging markets. Developing countries worldwide depend on Eurodollar borrowing for development finance, corporate lending, and government debt. Turkey, Argentina, Brazil, South Africa, Indonesia. Dozens of emerging markets have substantial dollar-denominated debt borrowed from Eurodollar markets. This creates the same currency mismatch problems that destroyed countries in the 1980s and 1990s. When emerging market currencies weaken, dollar debt burdens explode. When the Fed raises interest rates, Eurodollar rates follow, increasing debt service costs. The vulnerabilities that caused previous crises remain embedded in the system. Third, it's deeply integrated with global trade. International trade is predominantly invoiced in dollars. Roughly 80% of trade finance is dollar-denominated. This means exporters and importers worldwide need access to dollars for working capital, letters of credit, and trade settlement. The Eurodollar system provides this access. Think about the implications. A Chinese company selling goods to Europe typically invoices in dollars, not yuan or euros. They need a dollar loan to finance production before receiving payment. A European buyer needs dollars to pay the Chinese seller. Banks in Hong Kong, London, and Singapore provide these dollars through the Eurodollar system. If the Eurodollar system were disrupted, if dollar funding dried up, global trade would seize up. Companies couldn't finance shipments, buyers couldn't pay sellers, supply chains would break. This gives the Eurodollar system enormous systemic importance beyond finance. It's critical infrastructure for the global economy. Fourth, it's evolved beyond traditional banking. Modern Eurodollar activity includes complex derivatives, currency swaps, and structured finance transactions. Companies use cross-currency swaps to synthetically create dollar funding without borrowing dollars directly. Banks use foreign exchange derivatives to hedge dollar exposures. The system has become more sophisticated, but also more opaque. The dollar swap market, where institutions exchange other currencies for dollars temporarily, is enormous, exceeding $60 trillion notional value. These swaps create synthetic dollar positions that don't show up in traditional measures of Eurodollar activity. The true size of offshore dollar obligations is significantly larger than official statistics suggest. Fifth, central bank swap lines have become permanent infrastructure. After 2008, the Federal Reserve established standing swap line agreements with major central banks, the ECB, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada. These institutions can now borrow unlimited dollars from the Fed during periods of market stress. This was a tacit admission that the Fed is the lender of last resort for the global dollar system, not just the US banking system. When dollar funding markets freeze, the Fed will provide dollars to foreign central banks to support their banking systems. This is now official policy, not an emergency improvisation, but the standing swap lines also reveal the system's fragility. The fact that permanent emergency measures are necessary proves the Eurodollar system remains inherently unstable. We're one crisis away from needing them again. The COVID-19 pandemic in 2020 provided a recent demonstration. When the pandemic triggered global financial stress in March 2020, dollar funding markets immediately froze. The LIBOR OIS spread spiked. Commercial paper markets seized up. Repo markets became dysfunctional. The dynamics were remarkably similar to 2008, though faster and more intense. In a matter of days, not weeks, the offshore dollar system went from functioning to frozen. Foreign central banks activated their Fed swap lines, borrowing over $400 billion in emergency dollar liquidity. The Fed also created new facilities to purchase corporate bonds and commercial paper, directly supporting credit markets. The fact that a public health crisis triggered Eurodollar system stress reveals how fragile the system remains. Any shock, financial, economic, or geopolitical, can disrupt confidence and freeze dollar funding markets. The triggers are unpredictable, but the vulnerability is constant. Look, the modern Eurodollar system operates in a strange space between private markets and public support. It's nominally private. Banks make commercial decisions about dollar lending and borrowing, but everyone knows the Fed will intervene during crisis. This creates moral hazard while failing to provide the stability of a truly public system. Regulatory efforts since 2008 have been modest. Basel III rules require banks to hold more capital and liquidity, including liquid dollar assets for banks with significant dollar operations. Stress tests examine banks' resilience to hypothetical shocks. Resolution planning, living wills, requires large banks to demonstrate they could be wound down without systemic chaos. These reforms help on the margins. Banks are somewhat safer than in 2007, but the fundamental structure remains unchanged. Offshore dollar banking operates with limited oversight. No international regulator has authority over the system. Maturity mismatches and currency mismatches persist. The system depends on confidence and continuous funding availability. Some economists argue the Eurodollar system is an efficient allocation mechanism. It directs dollar savings to productive investments globally. The fact that it operates offshore with minimal regulation keeps costs low and efficiency high. Interference would reduce welfare without improving stability. This argument ignores the crisis history. The Eurodollar system hasn't just experienced one or two accidents. It's repeatedly created or amplified major financial crises. Latin America 1980s, Mexico 1994, Asia 1997, Global 2008, COVID 2020. The pattern is clear. The system is structurally fragile, and fragility creates enormous costs when it breaks. Other economists propose more radical reforms. Some suggest creating an international lender of last resort, a global central bank with authority to provide emergency liquidity and regulate cross-border banking. The IMF could be expanded for this role, or a new institution created, but this faces political obstacles. Countries are unwilling to cede sovereignty to an international institution. The US is particularly resistant. Why should America empower an international body to regulate the dollar? The Fed already struggles with the politics of rescuing foreign banks. A formal international structure would be even more controversial. Another proposal is to reduce dollar dependence, encourage more trade invoicing in other currencies, develop alternatives to dollar financing, reduce the dollar's reserve currency dominance. China has pushed this agenda, promoting the yuan's international use and establishing alternatives to dollar payment systems. These efforts have had limited success. The dollar's network effects are powerful. It's used because others use it, and switching costs are high. The Eurodollar system itself reinforces dollar dominance by making dollars easily available globally. The system is self-perpetuating. The crypto community sometimes argues that Bitcoin or other cryptocurrencies could replace the dollar for international transactions. But crypto lacks the stability, scale, and legal infrastructure for serious trade finance. It's a curiosity, not a genuine alternative for the trillions in dollar-denominated commerce that happen daily. What's interesting is that the Eurodollar system's existence highlights a fundamental tension in international finance. Countries want monetary sovereignty, control over their own currencies and credit conditions, but they also want access to the world's reserve currency for trade and investment. These goals conflict when the reserve currency operates partly outside any country's control. The United States faces its own dilemma. The dollar's global dominance benefits America. It allows the US to borrow cheaply, project economic power, and benefit from seigniorage, profit from creating currency the world wants to hold. But this dominance creates responsibilities. The Fed must stabilize the global dollar system during crises, requiring politically controversial rescues of foreign institutions. Treasury officials sometimes talk about dollar diplomacy, using dollar dependence as leverage in foreign policy. If countries need dollars for trade and finance, and the US controls access to the dollar financial system, America can weaponize finance. Sanctions, asset freezes, and financial restrictions become powerful tools. But this weaponization risks creating incentives for countries to develop alternatives to the dollar system. If dollar dependence means vulnerability to American political decisions, rational actors will seek ways to reduce that dependence. China, Russia, and others are actively working on alternatives. Limited success so far, but the long-term trajectory is concerning for dollar dominance. The Eurodollar system sits at the center of these tensions. It makes dollars globally available, reinforcing dollar dominance, but it operates beyond American control, limiting the Fed's power over dollar stability. It creates fragility through its shadow banking characteristics, and it requires the Fed to act as global lender of last resort, a role that's politically controversial domestically. By 2025, the Eurodollar system is in a strange place, larger than ever, more important than ever, but also more recognized as problematic. Regulators understand the risks better than in 2007. Central banks have emergency measures ready. Banks maintain more capital and liquidity buffers. But the system's fundamental fragility remains. It's built on confidence and trust. It depends on continuous rollover of short-term funding. It creates currency and maturity mismatches that can become unpayable during stress. When the next crisis comes, and it will come, the Eurodollar system will again be at the center. The machine keeps running, profitable for banks, essential for trade, supported ultimately by the Federal Reserve's implicit guarantee. We've learned to live with the fragility, to manage it through emergency measures, to accept periodic crises as the price of an efficient global dollar system. Whether that's wisdom or folly remains to be seen. Chapter 9. Future Threats. The next Eurodollar crisis is inevitable. The only questions are when, what triggers it, and whether the system survives intact. Several specific threats could trigger the next crisis, each with unique characteristics, but all exploiting the Eurodollar system's fundamental vulnerabilities. Threat 1. Chinese dollar debt. Chinese entities, corporations, banks, and local governments have accumulated over $2 trillion in dollar-denominated debt. Much of this was borrowed when the Chinese yuan was strengthening, and dollar borrowing seemed cheap. But if the yuan weakens significantly, the real burden of these dollar debts explodes. China's economic growth is slowing. The real estate sector is in crisis. Local government debt is unsustainable. If these problems trigger broader financial stress, Chinese borrowers might struggle to repay dollar debts. Chinese banks could face dollar liquidity crises as external lenders refuse to roll. Overfunding. The US-China relationship adds another dimension. If political tensions escalate into financial warfare, Chinese banks' access to dollar funding could be deliberately restricted. The US could threaten to cut Chinese banks from dollar clearing systems or restrict their access to US financial markets. China would face a dollar crisis not from market forces, but from political decisions. This would be catastrophic not just for China, but globally. Chinese banks are deeply integrated into global finance. Chinese companies are critical to supply chains. A Chinese dollar crisis would ripple through Asia, affect European banks with Chinese exposure, and disrupt global trade. The Fed would face a terrible choice: provide dollar support to Chinese institutions and face domestic political backlash, or refuse support and watch a crisis spiral out of control. Either choice has enormous consequences. Threat 2. Emerging market cascade. Dozens of emerging markets have substantial dollar debt, corporate debt, government debt, and bank debt. Turkey, Argentina, South Africa, Indonesia, Brazil, and many others are vulnerable to dollar strength and rising US interest rates. If the Fed raises interest rates aggressively to fight inflation, which it did in 2022-2023, Eurodollar rates follow. Emerging market borrowers face higher debt service costs. Simultaneously, higher US rates often strengthen the dollar, increasing the local currency burden of dollar debts. This creates potential for a cascade. One country's crisis creates fear about others. Capital flees emerging markets broadly. Currencies weaken everywhere. Dollar debt burdens spike. More countries face crises. The contagion feeds on itself, just like in the 1980s and 1990s. The scale today is larger. Total emerging market external debt exceeds $8 trillion, much of it dollar-denominated. A broad emerging market crisis would strain the IMF, require massive Federal Reserve swap line usage, and potentially need unprecedented international coordination to contain. Threat 3. European bank dollar funding. Crisis. European banks still have massive dollar operations, over $8 trillion in dollar assets. These are funded partly by dollar deposits, partly by wholesale dollar borrowing, and partly through currency swaps. The funding is short-term and needs continuous renewal. European banks are in weaker shape than they admit. Many are struggling with low profitability, legacy bad loans, and exposure to troubled sovereign debt. If a major European bank fails or faces serious stress, dollar lenders might panic and refuse to fund any European bank, regardless of actual solvency. This was the 2008 dynamic, a general loss of confidence in European banks' dollar positions. It could happen again. Brexit, European political instability, or a recession could trigger renewed stress. The ECB would immediately activate its Fed swap line, but whether that would be enough depends on how severe the panic becomes. What's concerning is that reforms since 2008 haven't fundamentally changed European banks' dollar dependencies. They're required to hold more liquid dollar assets, but the basic structure, European banks running large dollar operations, remains intact. The vulnerability is still there. Threat 4. Shadow banking evolution. The shadow banking system keeps evolving, finding new ways to create credit outside regulation. Cryptocurrency lending, decentralized finance, DeFi, and private credit markets are all creating dollar-denominated credit with Eurodollar-like characteristics, minimal oversight, leverage, maturity mismatches. These new systems are smaller than traditional Eurodollar banking, but growing fast. More importantly, they're even less transparent. Regulators don't know who owes what to whom in crypto markets. DeFi protocols operate algorithmically without central counterparties. Private credit deals happen bilaterally without disclosure. When stress hits these markets, and it will, because leverage and maturity mismatches always create fragility, the contagion channels to the traditional financial system aren't clear. Banks have exposure to crypto. Hedge funds participate in DeFi. Pension funds invest in private credit. The connections exist but aren't well mapped. A crisis originating in shadow banking's newest evolution could stress the traditional Eurodollar system in unpredictable ways. Regulators might not understand what's breaking until it's broken. Threat 5. Geopolitical weaponization. The scariest scenario is the deliberate weaponization of Eurodollar dependencies. If the US decides to use dollar system access as a weapon, sanctioning entire countries, restricting transactions or freezing assets broadly, it could trigger a crisis by making dollar funding unavailable for political reasons rather than market reasons. This has already happened in limited ways. Russian banks were cut from dollar clearing after Ukraine invasion. Iranian banks face dollar sanctions. Venezuela has been largely excluded from dollar finance. But these were isolated cases involving pariah states. If the US weaponized dollar access against a major economy, China most plausibly, the Eurodollar system could fracture. Other countries would accelerate de-dollarization efforts. Alternative payment systems would gain traction. The dollar's dominance would be threatened not by market forces, but by political overreach. The Eurodollar system's stability depends on the perception that dollar access is granted based on commercial and regulatory criteria, not political whims. If that perception breaks, if dollars become a weapon rather than a neutral medium, the system's legitimacy erodes. You see, all these threats share common characteristics. They exploit the Eurodollar system's currency mismatches, maturity transformation, leverage and dependence on confidence. When confidence breaks, funding disappears. When funding disappears, institutions fail. When institutions fail, contagion spreads. The 2008 crisis taught the Fed how to respond. Massive liquidity provision, swap lines, emergency lending facilities. These tools are still available and would be deployed again. But each crisis requires larger interventions. Each crisis pushes central banks deeper into politically controversial territory. Each crisis raises questions about moral hazard and whether we're just postponing the inevitable reckoning. Some analysts believe the Eurodollar system is approaching a breaking point. The vulnerabilities are too large, the system too fragile, the potential triggers too numerous. Eventually, a crisis will be too big for even the Fed to contain, and the system will experience fundamental disruption. Others believe the system is resilient. It survived multiple crises and keeps recovering. Central banks have learned how to stabilize it. Banks have become more cautious. The system will muddle through crisis by crisis without fundamental breakdown. The truth probably lies between these extremes. The Eurodollar system will survive because too many powerful interests depend on it. But it will continue experiencing periodic crises that require massive interventions. We'll lurch from crisis to stability to crisis again, each time pushing boundaries a bit further. What won't happen, absent some revolutionary change in international monetary architecture, is fundamental reform. The system is too entrenched, too profitable for too many participants, and too essential to global trade. Politicians, regulators, and bankers will tinker at the margins but won't dismantle the structure. This means living with systemic fragility as the price of efficient global dollar markets. It means accepting that every decade or so, the Eurodollar system will nearly collapse and require rescue. It means the Federal Reserve's role as lender of last resort to the world, controversial, legally questionable, politically fraught, becomes permanent. The alternative would be reducing dollar dependence fundamentally, more trade in other currencies, development of genuine alternatives to the dollar for international transactions, reduced dollar borrowing by emerging markets and foreign banks. These changes would reduce Eurodollar system importance and therefore reduce systemic risk. But these changes would also reduce American financial power and the benefits the US derives from dollar dominance. They'd require international cooperation that seems politically impossible. And they'd take decades to implement, even if everyone agreed to pursue them. So we're left with the system we have, enormous, powerful, fragile, and essential. The Eurodollar market that started as a Cold War accident has become too big to fail and too complex to reform. It's the hidden empire of offshore dollars that runs the global economy, while remaining largely invisible to the public. When the next crisis comes, and it will come, remember that it didn't start yesterday. It started in 1957 with Soviet deposits in London banks. It grew through decades of regulatory arbitrage and financial innovation. It survived multiple crises through extraordinary interventions. And it continues because the alternative seems worse than the risks. The $15 trillion question is whether we can keep managing the risks or whether eventually the system will experience a crisis so severe that managing it becomes impossible. That question remains unanswered. So we've seen how US dollars escaped America's borders and created a parallel financial universe larger than most countries' entire economies. The Eurodollar market started with Soviet paranoia about asset seizures. It grew through British regulatory arbitrage and American banks avoiding the Federal Reserve. It expanded through petrodollar recycling and emerging market lending. It became systemic through its role in global trade finance and cross-border capital flows, and it nearly destroyed the global financial system in 2008 before being rescued by the Fed's unprecedented intervention. Today, the Eurodollar market is more important than ever. $15–20 trillion in offshore dollar banking that operates largely beyond regulatory control. It's the infrastructure for international dollar finance, the mechanism for trade financing, and the source of systemic fragility that periodically threatens global stability. When you step back and look at the full picture, what's remarkable is how accidental this all was. Nobody designed the Eurodollar system. No international conference established its rules. No treaty created its structure. It emerged organically from regulatory arbitrage, market forces, and the interaction of Cold War politics with financial innovation. Yet this accident has become one of the most important features of the global economy. The Eurodollar system determines credit availability for billions of people. It influences exchange rates, interest rates, and trade flows worldwide. It's the primary mechanism through which dollar dominance operates globally. And it's the weakest link in the international financial system, the place where crises consistently originate or amplify. The real lesson here isn't that shadow banking is inherently bad or that offshore finance should be eliminated. It's that we've created a system with enormous benefits: efficient global dollar allocation, easy trade finance, liquid international markets, but also enormous risks that we haven't adequately addressed. Every decade or so, the Eurodollar system experiences a crisis. Each time, the response is emergency intervention rather than fundamental reform. Central banks provide liquidity. Governments bail out failing institutions. International coordination prevents complete collapse. Then everyone breathes a sigh of relief and continues with modest tweaks rather than serious restructuring. This is understandable. The Eurodollar system serves powerful interests. Banks profit from offshore operations. Financial centers like London depend on Eurodollar business. Corporations need dollar financing for international operations, and the United States benefits from the dollar's global dominance, even if that dominance operates partly beyond American control. But understanding these incentives doesn't make the system less fragile. The vulnerabilities are real: currency mismatches, maturity transformation, leverage, opacity, and lack of genuine lender of last resort. These vulnerabilities have repeatedly created crises, and they remain embedded in the system today. Whether we like it or not, the next financial crisis will almost certainly involve the Eurodollar market. It might start in emerging markets facing dollar debt problems. It might start with a major European bank experiencing dollar funding stress. It might start in China as dollar debt becomes unpayable. Or it might start somewhere completely unexpected, some new form of shadow banking we haven't even recognized yet. The trigger is unpredictable, but the mechanism is consistent. Confidence breaks, funding disappears. Institutions face liquidity crises, contagion spreads through interconnected markets. The Federal Reserve intervenes to prevent complete collapse. We pull back from the brink, grateful for central banks' actions but troubled by the system's fragility. The question that remains is whether this can continue indefinitely. Can we keep experiencing periodic Eurodollar crises, keep rescuing the system, keep accepting the fragility as the price of efficiency? Or will eventually a crisis be so severe that even extraordinary intervention can't stabilize it? There are concerning signs that each crisis requires larger interventions. The Latin American debt crisis in the 1980s was contained with relatively modest bailouts. The Asian crisis required larger interventions. 2008 required unprecedented measures, trillions in government support and fundamental expansion of central bank roles. COVID required even faster and larger interventions. If the trend continues, the next crisis might require interventions that are politically impossible or technically infeasible. There might be a limit to how large central bank balance sheets can grow, how much political support exists for bailouts, or how much confidence markets maintain in official intervention. That would be the breaking point, the moment when a Eurodollar crisis can't be managed and the system experiences fundamental disruption. Whether that happens, when it happens, and what replaces the current system are unknowable, but the trajectory is concerning. Alternatively, perhaps we've learned enough to manage the risks indefinitely. Perhaps central banks have sufficient tools. Perhaps regulations, while imperfect, have reduced vulnerabilities enough. Perhaps the system will continue functioning through periodic crises without fundamental breakdown. History suggests crises keep surprising us. The Latin American debt crisis wasn't predicted. The Asian crisis shocked observers. 2008's severity stunned even knowledgeable officials. Each crisis revealed vulnerabilities that experts had missed or underestimated. This suggests humility about our ability to manage Eurodollar system risks. We don't fully understand the system. We can't see all the connections and vulnerabilities. When the next crisis comes, it will likely involve dynamics we didn't anticipate through channels we didn't monitor. What we can say with confidence is that the Eurodollar system will remain central to global finance. It's too entrenched to eliminate. Too many participants depend on it. Too much infrastructure is built around it. Whatever reforms happen will be incremental, not revolutionary.